Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Josef Schachter, founder of the Schachter Energy Report online at SchachterEnergyReport.ca. He's speaking to us from Calgary. Welcome back to the show, Josef.
My pleasure to be with you again, Jim.
Josef, West Texas crude over $90 a barrel. Is this a trend that's going to continue? And in Vancouver, which has the highest gasoline prices in North America thanks to the extra taxes they slap on here, we're not all that far from $2 a liter.
Yeah. Well, we went up 6 cents just in the last few days to $1.46, so it's going across the country, and the refining and marketing side of the big integrateds is going to be very profitable for them. The price of crude at $90 is there just on the hype and worry about supply disruptions if Ukraine is invaded by Russia, and if sanctions are put on against Russia, selling 1.25 million barrels a day to Europe of oil and selling about 40% of their natural gas needs. So I think the market, is kind of bifurcated here, because if you look at natural gas prices, they're sub $4 in the States right now. So while we have, $90 oil, natural gas, even though we had a big draw, and we've had 3 big draws in a week in the last 3 weeks of over 200 BCF, the market is not worrying about supply issues for natural gas. And on the LNG front for Europe, the Americans are sending large numbers of cargoes from the U.S. Gulf Coast, record amounts. The U.S. is now the largest LNG exporter in the world, bigger than Qatar, bigger than Australia. So to me, the issue simply is, after the Olympics are over on February 20th, does that start the countdown for any invasion? And to me, they really have maximum of 4 weeks, i.e. to the 3rd week of March, because once you get into late March, early April, you're into the spring thaw, and as you know, that doesn't bode well for heavy equipment moving in muck, as the Second World War showed, with the battles there. So really, if there's going to be an invasion of eastern Ukraine, or the whole of Ukraine is now being warned about, and the United States has moved troops to Poland and Romania, assuming that they may take the whole country and there's a refugee crisis. So I think that's what's in there, is a lot of speculation and hype. And the bottom line is Germany doesn't want to play ball if it's only eastern Ukraine. If it's the whole of the country, maybe the American pressure will say, okay, Nord Stream 2 does not happen, but will they cut off current supplies that are going from Russia to Western Europe? I don't believe that will happen. And if that is the case, the price of oil has $20 to $30 of air in it, which is the speculative assumption of significant supply disruptions.
Do we have enough oil to replace Russian oil if that does happen?
Well, the problem is you can replace it over time, but right now, if let's say on the 22nd of February they invade the whole country, and then the decision is made to sanction them and not buying any oil and not buying any natural gas. The LNG cargoes are coming in, so they can help in the short term through the end of winter of 21, 22. And the oil, there's probably quite a bit of storage, for commercial purposes, plus strategic reserves that most European countries have, so they could survive it. And then the question it becomes a logistics nightmare, because the oil that used to come and natural gas that used to come from Russia can find lots of buyers of that in Asia, particularly its buddy China. And so the people that used to sell to China will then say, okay, now we got to find a transportation system to move that oil to Western Europe. And in terms of natural gas, more LNG tankers going from Asia, and then slotting themselves into Europe to cover the post-winter period. So it's going to be a logistical nightmare if that happens. And if the worst scenario, some people are saying Ukraine is just the start, then it's the Baltic states. If that worst case scenario comes out, we're going into a severe recession and a severe stock market decline, because wars are uncertainty. Markets don't like uncertainty. I'm in the bear camp because I think we're going to see the stock market correct because of the tightening by the central banks around the world. We saw that massive increase in the inflation report, 7.5% CPI today, way above expectation. The core is at 6%. And you even got, a number of the economists now talking about 5 or 6 increases of a quarter, or 2 of 50 basis points, the first 50 basis in March when the Fed announces the decision. So there's a lot more fear in the market. The Dow peaked to 37,000, as you remember, just in the first 2 days of 2022, went down to 33,200. The most recent rally in the last 2 weeks took it back up to 36,000. My guess is, with the big decline today, if we start seeing this waterfall and go down below the low that we saw in the third week of January, which was 33,200, I think we're going to be going down very hard. My forecast is that the Dow is going to see 25,000 in Q3, and that we're going to be in a recession. If that happens, demand falls off. So oil has right now air because of the assumption of supply disruptions. But then if you lose 3 to 4 million barrels a day out of demand destruction because we go into recession, that's not good for oil. And even OPEC admits that with the high prices, a lot of new production is coming on. In the U.S., maybe 1 million barrels. In Canada, about 200,000 barrels. Brazil, about 200,000 barrels. Kazakhstan, all of that added up, and this is non-OPEC production, and this is the forecast that came out today by OPEC, is that non-OPEC production in 2022 will go up by 2.9 million barrels. Total demand is not going to grow by 1.5 million in the bull case, and in the bear case, we may have flat demand versus 2021, which means we start creating an inventory build in Q2, Q3, and once that happens and the days of inventory go up, then of course we're going to see much lower prices for crude oil. I think there's a risk of sub $60 WTI. I think we've talked before about 48 to 54 is my worst case scenario, and I'm standing with it. So what we're doing is we're again reminding our people about the internal deterioration in the market. It started with the meme stocks, now it's the FANGs. Facebook, Netflix have been clobbered. Amazon's not doing very well, and we're seeing more and more names get hit here. And so as the stool legs holding the market up start falling away, then we're going to see much lower prices, and the valuation versus the long-term mean is 35 to 40% below where we are today. So that's pretty nasty, and if it happens over 6 to 9 months, that can be very detrimental to investors' portfolios, and that's what we're guiding in our reports that people can take a look at on our website, or and then we do a free weekly macro piece on Ion Energy on the oil and gas. So if they just want oil and gas input, that they can get for free. If it's market related, then that's the paid product.
Mm-hmm. Now, with COVID restrictions being lifted, is that going to boost the economy enough to make up for any drop in oil use elsewhere?
Well, the COVID relaxation, I think, will help restaurants and will help people going out. I went to my first restaurant yesterday where I didn't have to show my QR code after the midnight in Alberta the day before, where that changed. But with the transportation blockages across Canada on the U.S. borders, be it, in Alberta, the border, Manitoba's got a problem now at the border with North Dakota. Of course, the Ambassador Bridge between Windsor and Detroit. You hit the economies and the factories, the auto manufacturing plants, the delivery of food. I've gone into stores and you see empty shelves in a lot of grocery lines, be it in the soups or be it in the in the breakfast cereal line. Kellogg's in the States is on strike, so there's no deliveries coming from a strike-bound organization. So to me, I think the supply chain problems are going to get worse. That means employment doesn't recover until those supply chain issues are resolved. So we may go out and eat and drink a little bit and commiserate over how bad things are. So the restaurant industry and the service sector will do better, but the manufacturing and the food supply, those areas are not going to get better for a while. And I don't think our glorious Prime Minister really has an answer to solve this problem, which is politically getting worse and getting more support by the right wing of the U.S. Political spectrum. We're seeing swastikas, we're seeing U.S. Confederate flags, we're seeing a lot of Trump signs in, right in downtown Ottawa. So, the fact that he's an absentee PM, I think, is not very good for this country's leadership situation.
We'll have more with Josef Schachter right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Josef Schachter. Josef, you're an energy expert. Do we have enough electrical energy if this EV vehicle thing ever happens for real? Because right now, it's still a minuscule amount of the market, and right now they can't even get regular cars made because of a chip shortage.
Yeah, I think we're talking a 20, 30, 35 situation where maybe 20, 30% of the cars are EVs. But the key thing is they've got to do two things. One, you have to get the battery range to go longer, which is, still, if I can't go from Calgary to Edmonton and back to visit the grandkids, on the charge before I leave, that doesn't work for me. I'm not going to be a buyer. And then the second part is, storage at the home. So if you put on the roof solar panels and you have a fast charging, thing in your car, in your house, in your garage, you're going to need to have a storage capability. So if there is, as you say, any shortage of electricity in the general market, that you can store your own electricity. And that really is a nascent market that really hasn't got its act together. And then, the whole thing of the cost, it's still pretty expensive. And so, prices are going to come down as, Toyota and Nissan and Volkswagen and GM and Ford bring out their competitive products at all the different price ranges from, basic to maximum premium luxury. I think as we have more alternatives, there's going to have to be charging stations built. The amount of dollars that's going to be needed is astronomical. And to assume that you can shut down the conventional fossil fuel industry at the same time is nonsense. We're going to need both. And over time, the dirtiest fuels will get thrown by the wayside, and the cleaner fuels like natural gas will continue to be used for creating electricity, for your own in your home heating. If you have gas, electric for your your stove, that's where you're going to see continued use. But the industry will be working on methane, carbon capture, all those things to improve the climate position of the fossil fuel industry. But over time, coal will probably go by the wayside. The heavier barrel oil that's not upgraded will probably see less demand longer term, unless they can really make breakthroughs on the environmental side. But I think light oil, condensate, and especially natural gas, that's my number one favorite commodity, will have until my lifetime and my kids' lifetime, my grandkids' lifetime, we're going to still be using natural gas.
One thing I never hear anybody mention is the fact that heavy oil makes the best asphalt. And what are we going to make our roads out of? Concrete and steel probably doesn't hold up all that well in Canadian winters.
No, that's why the Canadian, the heavy oil industry, the old plant in Lloydminster, the old Husky, which is now part of Cenovus, and the heavy oil used for asphalt in everywhere around the world. That's where it's going to be a big area of consumption because in the spring, summer, and fall is the heavy season when all of that is being used to make sure our roadways work properly. So I'm not saying that we're going to see that market go away, but it's going to be limited to how far it grows, given the environmental requirements that, assuming the OECD nations, abide by their 2030, 2035, and 2050 targets.
We do have a listener question for you, Joseph. It comes from Gordon Eschpeter. Gordon writes, "Hi there, I really enjoyed the Josef Schachter interview. Thank you very much. Could you please clarify your closing remarks with Joseph for me? It seems he was saying that now is a good time to take profits from energy. However, at the end, it sounded like there was supply interruptions. Energy was going to go up. Do you mean defensive energy stocks? Thank you very much, Gordon."
Well, I don't think there are such a thing as defensive energy stocks, so no, that doesn't happen. While the market is still focused on potential supply disruption, stocks in the energy sector are holding up as the price of oil is. But my view is people should be taking profits. Let's just say whatever your 100% position would be on energy specifically, why don't you take that down 20, 30% and have some cash so that if we do get the bargains that I believe will occur, you have some firepower to take advantage of it. We were table-pounding buyers in March 13th of 2020, and then during 2021 we were saying harvest gains. In our latest report, I showed that I also harvested some more gains last week, but kept the core position. And so I'm looking at it as if we have a decline into the 60 or less for WTI between now and Q3, and it's based on the fact of a runaway inflation situation, Federal Reserve chomping on monetary liquidity on both of the amount of money and the price of money. If you remember last year, they were buying bonds and mortgages at $120 billion a month. That stops in March, so that takes away $1.44 trillion of liquidity. Then you take into account that they stop maybe in June reinvesting the maturities. That takes $2 trillion out compared to putting $1.44 trillion in. That is a massive tightening of monetary conditions. And I think what's happening is because of the shortages of labor, because of the high inflation, because of the governments who are the biggest borrowers can't afford 4 and 5% interest rates, that maybe they've made the decision a recession is acceptable, slowing demand down, cooling off the rampant housing market, and cooling down wage pressure and inflation pressure. And I'm not saying that Paul Volcker's arrived back in town like we saw in 81, 82 for the Fed, but I think Powell may have taken on a more hawkish approach simply because the inflation has gotten out of control. Wage pressure and strikes are happening for more wage increases. Cost of living pressure is on for companies to increase it. Remember, the government gives you COLAs on your pensions and on wages. So if your Social Security in the States or CPP in Canada, those are COLA adjusted. So if we do have rampant inflation, they have to up those. Governments have massive deficits; they're not going away. So they have to maybe take a recession to cool everything down, and I think that the likelihood of that happening, Germany has already had the fourth quarter of 2021 negative. If the first quarter of 21 is negative, they're officially in recession, and I think we're going to see a data around the world that we see more and more countries soften and then go into recession during 2022. That will cool off inflationary expectations, bring down the price of many commodities that are elevated, and potentially in the Q3 of 2022, give us another fabulous buying opportunity in the energy sector, like not as good as what we had in March of 2020, but the index was 200. I think the index on the S&P TSX Energy Index could go down to 100. The Dow, which was 37,000, I think could go to 24, 25,000. That's a pretty severe hit to the portfolios, and people should start thinking about how they felt in late 2008, early 2009, when the market got hammered, and how severely hit their portfolios got. And maybe prudence says, why don't you harvest some of those gains, put some cash on the sidelines. You'll sleep at nights better when the markets are having down days of 500 points like it is today. And then if we do see another 10,000 points taken off the market, you'll have some cash reserves to take advantage and buy the bargains, depending upon the industry that you're interested in, and particularly, from my point of view, in the energy sector.
Joseph, thank you so much for chatting with us.
My pleasure, Jim, as always. Take good care.
My guest has been Josef Schachter, founder of the Schachter Energy Report, online at schachterenergyreport.ca. He was speaking to us from Calgary. If you have any questions for Joseph, he loves answering them. You can send them to info@howstreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.